Question 1. An investment advisor registered under the Investment Advisors Act of 1940 is required to file which of the following forms? A. Form U4. B. Form ADV. C. Form U5. D. Form BD. Answer: B. Form ADV. Investment advisors, IAs, register with either the SEC or state securities authorities by filing Form ADV, which is the uniform registration form for IAs. This form contains crucial information about the advisor's business, services, fees, and disciplinary history, allowing regulators and the public to assess their operations. Think of Form ADV as the primary disclosure document that defines an investment advisor's public identity and operational details. Remember, Form ADV is specifically for investment advisors, distinguishing it from forms used by broker-dealers or individual representatives. Question 2. Under the Uniform Securities Act, USA, which of the following individuals would most likely be excluded from the definition of an investment advisor representative, IAR? A. An individual who provides investment advice solely to family members for no compensation. B. An employee of an investment advisor who manages discretionary client accounts. C. A solicitor for an investment advisor who receives a fee for referring clients. D. An individual who supervises employees performing investment advisory functions. Answer: A. An individual who provides investment advice solely to family members for no compensation. An investment advisor representative, IAR, is typically an individual who works for an investment advisor and performs advisory functions, such as giving advice, managing accounts, or soliciting clients, for compensation. Individuals who provide advice exclusively to close family members without receiving any compensation for that advice are generally not considered to be engaged in the business of providing investment advice and therefore fall outside the definition of an IAR. The key elements for IAR status are acting on behalf of an investment advisor and receiving compensation for services. Always look for the presence of compensation and a business relationship when defining an IAR. Question 3. A client is considering purchasing a municipal bond. Which of the following statements regarding the taxation of municipal bonds is most accurate? A. Interest earned on municipal bonds is always tax-exempt at the federal, state, and local levels. B. Interest earned on municipal bonds is tax-exempt at the federal level, but may be subject to state and local taxes. C. Interest earned on municipal bonds is subject to federal income tax, but exempt from state and local taxes. D. Interest earned on municipal bonds is fully taxable at all levels, similar to corporate bonds. Answer: B. Interest earned on municipal bonds is tax-exempt at the federal level, but may be subject to state and local taxes. Interest income from municipal bonds is generally exempt from federal income tax. However, whether it's also exempt from state and local taxes depends on where the bond was issued and where the investor resides. If an investor buys a municipal bond issued by a state or municipality in their own state, the interest is typically triple tax exempt, meaning free from federal, state, and local taxes. If they buy a bond from another state, it will usually be subject to state and local taxes in their home state. This reciprocal immunity rule is critical for understanding muni bond taxation. Question 4. An investment advisor representative is helping a client analyze their current investment portfolio and future financial needs. The client expresses a strong desire to preserve capital and generate current income. Which of the following asset allocations would be most suitable for this client? A. 80% common stocks, 20% high-yield corporate bonds. B. 60% growth stocks, 40% balanced mutual funds. C. 70% money market funds, 30% short-term U.S. Treasury securities. D. 50% equity income funds, 30% investment-grade corporate bonds, 20% preferred stock. Answer: D. 50% equity income funds, 30% investment-grade corporate bonds, 20% preferred stock. A client prioritizing capital preservation and current income would benefit from a portfolio heavily weighted towards income-generating and lower volatility assets. Equity income funds focus on dividends. Investment-grade corporate bonds provide regular interest payments with relatively low default risk, and preferred stock offers fixed dividends. This mix contrasts sharply with growth-oriented or high-risk options that would expose the client to more capital risk or volatility than desired. Remember, suitability means aligning the investment strategy with the client's stated objectives, risk tolerance, and financial situation. Question 5. The federal law that requires most investment companies to register with the SEC and regulates their activities is the A. Investment Advisors Act of 1940. B. Securities Act of 1933. C. Investment Company Act of 1940. D. Securities Exchange Act of 1934. Answer: C. Investment Company Act of 1940. The Investment Company Act of 1940 specifically regulates the organization and operation of investment companies, such as mutual funds, closed-end funds, and unit investment trusts. This act mandates registration with the SEC and imposes various requirements aimed at protecting investors, including rules regarding disclosures, capital structures, and transactions with affiliates. It's important to distinguish this act from others that regulate securities issuance, trading, or investment advisors, as each federal law has a distinct focus. Question 6. An agent who is also an investment advisor representative, IAR, for the same firm must ensure that clients fully understand the capacity in which the representative is acting for each transaction. This is primarily to avoid which of the following? A. Churning. B. Commingling. C. Conflicts of interest. D. Free riding. Answer: C. Conflicts of interest. When an individual acts in dual capacities as both an agent, earning commissions on trades, and an IAR, providing advice for a fee, there is a potential for conflicts of interest regarding how they recommend or execute transactions. For instance, an IAR might be tempted to recommend a transaction that generates a commission rather than one that is solely in the client's best interest. Full disclosure of the representative's capacity for each service or transaction helps clients understand potential biases and make informed decisions, which is a cornerstone of ethical practice. Transparency is key to managing such conflicts. Question 7. Under the Uniform Securities Act, USA, which of the following would be considered a security? A. A fixed annuity contract. B. A certificate of deposit, CD, with a maturity of 9 months. C. A variable annuity contract. D. An interest in a retirement plan under ERISA. Answer: C. A variable annuity contract. Under the Uniform Securities Act, a variable annuity contract is considered a security because its value and payout vary based on the performance of underlying investment options, and it involves an investment risk borne by the purchaser. In contrast, fixed annuity contracts offer guaranteed payouts and are generally not considered securities. Certificates of deposit and interests in ERISA plans generally fall outside the definition of a security under the USA. Remember that if an investment product exposes the investor to market risk and relies on professional management, it's highly likely to be classified as a security. Question 8. An investment advisor, IA, has determined that a client's risk tolerance is moderate, and their investment objective is long-term growth. Which of the following investment strategies would be most appropriate? A. Concentrating investments in a single industry sector. B. Investing primarily in money market instruments and short-term bonds. C. Diversifying investments across various asset classes, including a mix of equities and fixed income securities. D. Engaging in frequent trading of options and speculative stocks. Answer: C. Diversifying investments across various asset classes, including a mix of equities and fixed income securities. For a client with a moderate risk tolerance and a long-term growth objective, diversification across multiple asset classes is the most suitable strategy. This approach balances the growth potential of equities with the stability and income of fixed-income securities, helping to mitigate overall portfolio risk while still aiming for appreciation over time. Concentrating investments or engaging in speculative trading would be too risky for a moderate risk tolerance, while a portfolio solely of money market instruments would not meet a long-term growth objective. Diversification is a fundamental principle for risk management and achieving balanced returns. Question 9. An investment advisor provides advice for compensation but does not take custody of client funds or securities. Under the Investment Advisors Act of 1940, how often is this advisor generally required to send an updated Form ADV Part 2, brochure, to clients? A. Annually, within 90 days of the end of its fiscal year. B. Semi-annually. C. Only upon initial engagement with the client. D. Only if there are material changes to the information. Answer: A. Annually, within 90 days of the end of its fiscal year. Registered investment advisors are generally required to deliver an updated Form ADV Part 2, the brochure, to clients annually, within 90 days of the end of their fiscal year, if there have been material changes from the previous version. This annual update ensures clients receive current information about the IA's business, services, fees, and disciplinary history. Even if there are no material changes, the annual delivery requirement ensures ongoing transparency. Think of this as an annual report from your financial advisor to you, providing a transparent look at their operations. Question 10. Which of the following actions taken by an investment advisor would be considered an unethical business practice under the Uniform Securities Act, USA? A. Charging a reasonable fee for financial planning services. B. Exercising discretion in a client's account without prior written authorization. C. Providing clients with a written disclosure of all fees and charges. D. Recommending investments that align with a client's stated risk tolerance. Answer: B. Exercising discretion in a client's account without prior written authorization. Exercising discretion in a client's account, meaning making investment decisions, like security, amount, or action, without the client's specific approval for each trade, is a serious violation unless the advisor has obtained prior written authorization from the client. This protects clients from unauthorized trading and ensures their control over their investments. This rule is a cornerstone of client protection and ethical conduct, emphasizing that an investment advisor must have explicit permission to act on behalf of a client without their direct instruction. Question 11. An investor is reviewing a mutual fund's performance and notices its expense ratio is 1.5%. This means that for every $1,000 invested in the fund, approximately how much is deducted annually for operating expenses? A. $1.50. B. $15. C. $150. D. $1,500. Answer: B. $15. An expense ratio of 1.5% means that 1.5% of the fund's assets are used to cover its operating expenses each year. To calculate the annual deduction for a $1,000 investment, you multiply $1,000 by 0.0150, which is 1.5% expressed as a decimal. This equals $15. The expense ratio directly impacts a fund's net returns, as these costs reduce the investment's performance. A lower expense ratio generally means more of the investment return goes to the investor. Question 12. All of the following are typically considered suitable long-term investments for a younger client, example in their 20s or 30s, saving for retirement, except A. Growth stocks. B. Index funds. C. Variable annuities. D. Short-term certificates of deposit, CDs. Answer: D. Short-term certificates of deposit, CDs. Short-term certificates of deposit, CDs, are generally low-risk, low-return investments suitable for short-term savings or capital preservation, not for long-term growth needed for retirement planning over decades. For a younger client with a long time horizon, investments like growth stocks, index funds, or even variable annuities offer higher growth potential necessary to combat inflation and accumulate significant wealth for retirement. The long time horizon allows them to absorb the higher volatility associated with growth-oriented investments. Question 13. Which of the following is considered an unethical practice known as churning? A. Executing a large block trade for a client with prior authorization. B. Recommending a diversified portfolio of mutual funds to a client. C. Engaging in excessive trading in a client's account to generate commissions. D. Failing to disclose a material fact about an investment to a client. Answer: C. Engaging in excessive trading in a client's account to generate commissions. Churning is the unethical practice of executing trades in a client's account that are excessive in size or frequency, solely for the purpose of generating commissions for the broker or advisor, rather than serving the client's investment objectives. This practice directly violates an investment professional's fiduciary duty and suitability obligations. The key indicator of churning is the excessive nature of the trading activity driven by the representative's personal gain, rather than the client's best interest. Question 14. An investment advisor representative, IAR, is determining a client's suitability. Which of the following factors is generally considered the least important when making investment recommendations? A. Client's financial goals and objectives. B. Client's risk tolerance. C. Client's social security number. D. Client's time horizon. Answer: C. Client's social security number. While a client's social security number is essential for account opening, tax reporting, and identity verification, it is generally the least important factor when determining investment suitability. Suitability focuses on a client's financial profile, including their financial goals, risk tolerance, time horizon, liquidity needs, and existing holdings, to ensure that recommended investments align with their financial situation and objectives. The Social Security number is an administrative detail, not an investment determining factor. Question 15. The Uniform Securities Act, USA, gives the administrator of a state the power to do all of the following except: A. Conduct investigations. B. Issue cease and desist orders. C. Subpoena witnesses and records. D. Change federal securities laws. Answer: D. Change federal securities laws. The administrator, as the chief securities regulator in a state under the Uniform Securities Act, USA, has broad powers to enforce state securities laws, including conducting investigations, issuing cease and desist orders, and subpoenaing documents and testimony. However, a state administrator does not have the authority to change federal securities laws. Federal laws are enacted by the U.S. Congress and enforced by federal agencies like the SEC, operating independently from state regulatory bodies. Question 16. A client has invested in a limited partnership. Which of the following statements regarding the taxation of limited partnerships is most accurate? A. Limited partnerships are subject to corporate income tax at the partnership level. B. Limited partnerships are pass-through entities, meaning profits and losses are passed directly to the partners. C. Limited partnership losses can always be used to offset ordinary income without limitation. D. Limited partnership distributions are typically taxed as capital gains. Answer: B. Limited partnerships are pass-through entities, meaning profits and losses are passed directly to the partners. Limited partnerships are known as pass-through or flow-through entities, meaning the partnership itself does not pay corporate income tax. Instead, the partnership's income, gains, losses, deductions, and credits are passed directly to the individual limited partners, who report them on their personal tax returns. This avoids double taxation, which is a key advantage. Keep in mind that passive activity loss rules often limit the deductibility of losses for individual partners. Question 17. Under the Investment Advisors Act of 1940, an investment advisor that takes custody of client funds or securities must meet certain requirements. Which of the following is not typically a requirement for an advisor with custody? A. Segregate client funds and securities from the advisor's own assets. B. Send quarterly account statements to clients. C. Arrange for an annual surprise examination by an independent public accountant. D. Maintain a minimum net worth of $250,000. Answer: D. Maintain a minimum net worth of $250,000. While some investment advisors are subject to minimum net worth or bonding requirements, the specific $250,000 figure is not a general requirement for all SEC-registered investment advisors with custody under the Investment Advisors Act of 1940. SEC-registered advisors with custody must segregate client assets, send quarterly statements, and arrange for an annual surprise examination. Net worth requirements for IAs are primarily a state-level concern under the Uniform Securities Act, USA, and vary by state. Question 18. An investor is concerned about the impact of inflation on the purchasing power of their fixed-income investments. Which of the following risks is this investor primarily concerned with? A. Interest rate risk. B. Credit risk. C. Purchasing power risk. D. Liquidity risk. Answer: C. Purchasing power risk. Purchasing power risk, also known as inflation risk, is the risk that the returns from an investment will not keep pace with inflation, thereby eroding the real value or purchasing power of the investor's money over time. For fixed-income investments, whose interest payments are fixed, rising inflation means that those fixed payments will be able to buy less in the future. This risk is especially relevant for long-term fixed-income investments where the effects of inflation can compound significantly. Question 19. According to the Investment Advisors Act of 1940, which of the following is true regarding solicitor arrangements for investment advisors? A. Solicitors must always be registered as investment advisor representatives. B. Cash referral fees can only be paid to solicitors who are also registered investment advisors or IARs. C. Disclosure of the solicitor's compensation is not required if the fee is paid by the advisor, not the client. D. Solicitors may never be compensated based on assets under management. Answer: B. Cash referral fees can only be paid to solicitors who are also registered investment advisors or IARs. Under the Investment Advisors Act of 1940 Rule 206(4)(3), commonly known as the cash referral rule, if an investment advisor pays a cash fee to a solicitor for referring clients, the solicitor must typically be a registered investment advisor or an investment advisor representative of a registered advisor. This rule aims to ensure that individuals receiving compensation for client referrals are subject to regulatory oversight and fiduciary duties. There are specific disclosure requirements for solicitor arrangements, regardless of who pays the fee. Question 20. An investment advisor representative is explaining the concept of time value of money to a new client. Which of the following statements best describes this concept? A. Money today is worth more than the same amount of money in the future due to its potential earning capacity. B. The value of money is constant over time, regardless of inflation or interest rates. C. Future money is always worth more than present money because of economic growth. D. The time value of money only applies to investments in the stock market. Answer: A. Money today is worth more than the same amount of money in the future due to its potential earning capacity. The core principle of the time value of money, TVM, is that a dollar received today is worth more than a dollar received at some point in the future. This is because a dollar received today can be invested and earn interest, thereby growing into a larger sum over time. TVM considers the effects of interest rates and inflation, highlighting that the opportunity cost of not investing today means foregoing potential returns. This fundamental concept underpins many financial calculations, from retirement planning to bond pricing. Question 21. Which of the following federal acts primarily regulates the initial public offering, IPO, of securities? A. The Securities Exchange Act of 1934. B. The Investment Company Act of 1940. C. The Securities Act of 1933. D. The Trust Indenture Act of 1939. Answer: C. The Securities Act of 1933. The Securities Act of 1933 is often referred to as the Paper Act, or the Truth in Securities Act, because its primary purpose is to regulate the primary market, specifically the initial issuance of securities. It requires that investors be provided with full and fair disclosure of all material information regarding new securities offerings, primarily through the registration statement and prospectus, before they are sold to the public. This act aims to prevent fraud in the sale of new issues. Question 22. Which of the following describes a situation where an investment advisor has custody of client funds or securities under the Investment Advisors Act of 1940? A. The advisor has discretion over the client's account but no direct access to the funds. B. The advisor holds a general power of attorney from the client, allowing them to withdraw funds. C. The advisor receives advisory fees directly from the client's account at a qualified custodian. D. The advisor has access to client bank accounts solely for billing purposes. Answer: B. The advisor holds a general power of attorney from the client, allowing them to withdraw funds. An investment advisor is deemed to have custody of client funds or securities if they have actual possession or direct control over client assets, or the ability to obtain possession or control. Holding a general power of attorney that allows the advisor to withdraw funds or securities from a client's account would constitute custody, as it grants direct access to the client's assets. Merely having discretionary trading authority, receiving advisory fees directly from a custodian, or having limited access for billing purposes generally does not trigger custody requirements. Question 23. An individual is considering purchasing a bond and is comparing its yield to maturity, YTM, with its current yield, CY. If the bond is trading at a discount, which of the following relationships is true? A. YTM CY the nominal yield. B. Nominal yield CY YTM. C. CY YTM nominal yield. D. YTM CY nominal yield. Answer: A. YTM CY nominal yield. When a bond is trading at a discount, meaning its market price is below its par value, its yield to maturity, YTM, will be the highest, followed by its current yield, CY, and then its nominal yield, coupon rate, will be the lowest. This is because the YTM considers both the annual interest payments and the capital gain that will be realized when the bond matures at par. The current yield only considers the annual interest payment relative to the current market price, and the nominal yield is simply the stated coupon rate. The discount provides an additional return beyond the coupon. Question 24. A client needs immediate liquidity and capital preservation. Which of the following money market instruments would be most suitable? A. 30-year U.S. Treasury bond. B. Common stock. C. Commercial paper. D. Preferred stock. Answer: C. Commercial paper. Commercial paper is a short-term, unsecured promissory note issued by corporations, typically with maturities ranging from a few days to 270 days. It is highly liquid and considered a safe investment, making it suitable for clients prioritizing immediate liquidity and capital preservation. In contrast, 30-year U.S. Treasury bonds have significant interest rate risk and are not highly liquid for short-term needs, while common and preferred stocks are subject to market volatility and do not primarily offer capital preservation. Question 25. Under the Uniform Securities Act, USA, a broker-dealer's registration may be revoked or suspended for all of the following reasons except: A. Insolvency of the broker-dealer. B. Failure to supervise agents properly. C. Engaging in unethical business practices. D. having agents who are taking a securities exam. Answer: D. Having agents who are taking a securities exam. A state administrator can suspend or revoke a broker-dealer's registration for reasons such as insolvency, failure to supervise employees adequately, or engaging in fraudulent or unethical business practices, as these represent failures to comply with regulatory standards or protect the public. However, the mere act of a broker-dealer's agents taking a securities exam is a routine part of the licensing process and would never be a reason for disciplinary action against the firm. This option is designed to test your understanding of legitimate disciplinary grounds.